Boost your credit score. Tips and tricks. Is your credit score holding you back? Today, I'm going to share the most effective ways to raise it, fast. In this video, we'll cover everything from credit score basics to payment history, credit utilization, and even some overlooked tips that can make a big difference. Let's dive in. If you've ever been turned down for a loan or ended up with a higher interest rate than you expected, you already know just how important a good credit score can be. Your credit score affects countless aspects of your financial life, like whether you can get approved for a mortgage, rent an apartment easily, or even land certain jobs that require a credit check. It also determines what interest rates and loan terms you qualify for, which can save or cost you thousands of dollars over time. In this video, we're breaking down exactly what goes into your credit score, and more importantly, how you can boost it. Whether you're aiming for a new car, hoping to buy a home, or simply want more financial freedom, these strategies can make a real difference. Let's start by covering the basics. Credit scores typically range from 300 to 850, and they measure how likely you are to repay a loan on time. If you've heard terms like FICO or Vantage Score, those are just different scoring models that lenders use to evaluate your creditworthiness. Regardless of the specific scoring model, many of the same factors apply. The 5 main components that can influence your credit score are: 1. Payment history, 35%, whether you pay on time or have late or missed payments. 2. Credit utilization, 30%, how much of your available credit you're currently using. 3. Length of credit history, 15%, the age of your credit accounts and how long you've been managing credit. 4. New credit inquiries, 10%, how many times you've applied for new credit recently. 5. Credit mix, 10%, the variety of credit accounts you have, like credit cards, loans, and mortgages. Knowing these factors helps you see where you might need the most work. For example, if you never miss a payment but you're maxing out your credit cards, you'll need to focus on utilization. Let's talk about payment history first. This one is pretty straightforward. Always pay your bills on time. Late payments not only hurt your score but can stick around on your credit report for up to 7 years. If you tend to forget due dates, consider setting up automatic payments or creating calendar reminders. Even a single missed payment can have a big impact, especially if your credit history is relatively short. Next up is credit utilization, which is the percentage of credit you're using compared to your total credit limit. Most experts advise keeping this under 30%, and some even recommend under 10% for the best results. Here's a quick example. If you have a $10,000 total credit limit across your cards, you'll want to keep your outstanding balances under $3,000 to stay below 30%. If you notice you're creeping above that threshold, try paying down your balances more aggressively, or see if you can request a higher credit limit. Just remember, a higher limit isn't an invitation to spend more, it's a tool to keep your utilization ratio low. Pro tip: if you can pay off your credit card balances in full each month, that's ideal. Not only will you avoid interest charges, but your utilization ratio will stay low, which often leads to a higher credit score. Now let's look at length of credit history. Lenders and scoring models like to see that you have experience managing credit responsibly over a longer period of time. That's why it's usually best to keep older credit cards open, even if you don't use them much. Closing an old account can reduce the average age of your credit, which may lower your score. New credit inquiries or applications can also affect your score. Every time you apply for a new credit card, car loan, or mortgage, the lender typically performs a hard inquiry on your credit report. These hard inquiries can stay on your report for about 2 years and may lower your score slightly, especially if you open multiple accounts in a short time frame. If you're planning to apply for a major loan, like a mortgage, try not to open any new credit cards or financing plans shortly before you submit that application. Minimizing new credit inquiries keeps your score as high as possible when you need it most. Diversifying your credit mix. Credit mix means having different types of credit accounts in your name. This can include credit cards, installment loans, like a car loan or student loan, and mortgages. While this category only makes up about 10% of your score, it can still have a positive impact if everything else is in good shape. However, it's important not to take on debt just to diversify. If you don't actually need a certain type of loan, don't open one just for the sake of improving your credit mix. Focus on making smart financial decisions that fit your life and goals. If you happen to have both revolving credit, like credit cards, and installment loans, like an auto loan you're paying on time, that already looks good from a credit mix standpoint. Extra boosters and monitoring. Now let's talk about some extra boosters that can help your credit score climb a little faster. 1. Secured credit cards. These are ideal if you have poor or limited credit history. 1. You put down a refundable security deposit, and that deposit acts as your credit limit. 1. By using the card responsibly, paying on time, and keeping your balance low, you can raise your score relatively quickly. 2. Credit building loans. Some banks or credit unions offer small, short-term loans designed to help you build credit. 2. You make on-time payments, and that payment history is reported to the credit bureaus, boosting your score if you're consistent. 3. Monitor your credit reports. Each of the major bureaus, Equifax, Experian, and TransUnion, provides a free credit report every 12 months through annualcreditreport.com. 3. Check each one for errors or signs of fraud. 3. If you spot any mistakes, dispute them right away. 3. Correcting inaccuracies can sometimes lead to a quick score boost. 4. Experian Boost or similar services. These services let you add recurring bills, like utility or streaming subscriptions, to your credit report, potentially helping you gain points if you've been paying on time. 5. Pay off balances strategically. If you have multiple credit cards, it might help to focus on paying down the ones with the highest balances first to quickly lower your utilization on specific accounts. 5. Alternatively, you could use the snowball method to knock out smaller balances, freeing up more money to tackle bigger debts. 5. Strong credit score can open up better financial opportunities, from lower interest rates on mortgages and car loans, to easier approvals on rental applications, and sometimes even better insurance premiums. By focusing on paying your bills on time, keeping your credit utilization low, managing the length of your credit history, limiting new credit inquiries, and diversifying your credit mix responsibly, you can steadily increase your score. Don't forget to monitor your credit reports regularly for any errors or fraudulent activity, and consider leveraging extra boosters like secured credit cards or credit building loans if you need that additional push. If you found this video helpful, subscribe for more personal finance tips, and share it with someone who might be looking to improve their credit. Thank you so much for watching, and remember, your credit score is a powerful tool for achieving the financial freedom you deserve. See you next time.